Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading.
Let's do it for instance here. So let's say that I'm going to go back to the euro dollar. Oh, I'm going to pick on the other one here. The daily chart of the euro dollar. And I did want to show you that if you are bringing this, so depending on what you use for your charting package, whether you get it from your broker or whatever it is, you may not be able to bring up the currency pairs such as I've done. So if you're not a Forex trader, and you may not be able to bring up the euro-dollar exchange rate itself. And if you can't, it's no big deal. What I've just brought up was EUU. This is the index that the FX options for the euro-dollar that we were talking about today are based on. So as you can see, although you will get gaps here because it doesn't include the overnight movements in the Forex, the trend and et cetera, it's all the same. So you're not at that much of a disadvantage. And you can see the last couple of days how this trend has really been moving up quite a bit on EUU to match what we can see on just the euro-dollar exchange rate itself. Okay, so let's go back to that. All right, so it's Tuesday. The market's closed. We have an opportunity tomorrow to kind of evaluate and see what's going on. And as we pay attention to what's happening in the market tomorrow, let's just assume that everything comes out tomorrow very neutral. The traders are relatively balanced, and we don't ultimately get a whole lot of movement in the Forex. So we're essentially at the same price that we are right now in the markets. We're approaching the close, and we want to get ready for taking a potential opportunity to profit from a potential surprise Thursday morning, because we may or may not know. Now, Forex traders usually start trading the news by trying to jump in and out really quick as the announcement actually happens. And so for those of you who have been Forex traders, you know the problems with that. Will your dealer actually fill your order? When will they fill your order? Will they honor your stop loss? It goes on and on and on. So trying to execute the trade during the market volatility is very difficult. Trying to predict it in advance is also difficult for the reasons I suggested in our webinar. We can get whipped out very easily. And we don't want to trade without risk control, so we're in this we're in this real quandary where we want to take advantage of the opportunity, but we also don't want to leave our position unprotected. But if we protect it, we know there's a very high likelihood that we could be right on our analysis, but would be whipped out anyway. So our win-loss ratio starts getting really damaged, which this is problematic for short-term traders. So rather than dealing with that, the alternative we might investigate, and if you're a Forex trader, I would suggest put it to the test. Paper trade this a few times. It won't cost you anything. And you'll get a feel for it to say, oh, well, I see how I could use this to increase my odds of walking away with a trade that closed successful. So here's the for instance. Let's say that, that we were evaluating this today and we were setting up our trade. So I would look at, it is a hypothetical example, all right, not a recommendation. So I would buy to open the EUU calls, and let's say I were looking at something that was maybe out of the money slightly. So instead of the 130s, which would be exactly at the money, maybe I'm looking at something that's a little bit out of the money. So we'll say the 132 calls. Whoops, 132 calls. And right now, I checked prices before I got online, and it may have moved a little bit since the market closed, but it was around $1, so or $100 per contract, and this expires in October. So relatively straightforward. It's not very complicated, and I know that dollar, that $100, is basically that I'm staking that in this particular trade. So now, when I'm talking about time value, all of this $1 is all time value. So this is the darker side of trading options, is that you have to deal with that. And if the market doesn't move anywhere, I'm going to take a hit. So I will wind up having lost a little bit of money because time value will have melted and volatility would have come out of the market. And if the market declines a bit, that'll also hurt me. So I still have risk, obviously. But if the trade works out, it's almost as though I put in a limit order to get long with you could kind of think about it as if I were using a 100 pip stop. So I would probably want to be anticipating that I have some pretty decent upside in order to justify this particular trade. But if the move happens, it's big enough, and it happens in the short enough term, then just as the two case studies that I used both on YUK a minute ago, and then on the dollar yen, as well as the example that we looked at on EUU on the euro dollar, the return definitely justified the amount of risk. So I have, if these are expiring in October, then I have about 30 days to expiration. So if the market didn't work out, just moved up a little bit, but I still felt pretty bullish, I could even let it ride for a few days or a few weeks if I like. Now, one of the things that I should mention that I always options trading, I find that oftentimes traders, especially traders coming out of the Forex or wanting to diversify a little bit and add another weapon to their arsenal of Forex trading, sometimes they forget that one of the advantages with options is you have a lot of flexibility. So it's not just buying calls or buying puts. Sometimes it's somewhere in the middle. So in prior webinars, I've talked about things like straddles or strangles, both long and short, which definitely have their place. But a lot of traders will also trade vertical spreads. So, and for those of you who are options traders, this is old hat, but this will make a lot of sense to you. But I want to run through the example anyway, because I think it's very relevant to what we're dealing with here on the euro dollar that's beginning to break out. We have overhead resistance up around 133. The market could get there, definitely within even the next few days. It would be reasonable to be able to get there. And the reason why a trader might trade a vertical spread in this condition is that then they can reduce the impact of time value. And they don't always give up a whole lot of upside when you're thinking about things realistically. Let me give you a for instance, okay? So let's say that we did buy the EUU 132 calls that expire in October, and they're currently trading for $1. But at the same time, we also sell to open the EUU 133 calls at, and when I checked prices just a little bit ago, they were trading for about 63 cents. Is what we could get for it. So we would get paid that 63 cents because we wrote the call. So we have a 63 cent, let's call that a credit. Okay. So when we net those two out, what have I really invested? Well, I've invested about 37 cents. So if the market breaks out and if it closes above 133 by expiration, so if the move happens, we get things work out, and we start to see prices up above 133. Even if it just hit prices above 133 by the time we hit expiration in October, then this trade will be worth about $1. And if we invested 37 cents, then that gets us really close to about a 200% gain. And a trader may evaluate this kind of a strategy, turning an outright long call position into a vertical spread, because you don't have to post margin for it per se. Your broker is going to require you to post the debit for it. And it helps reduce some of the exposure we have here to time value. So given the right market conditions, it may make a lot of sense. If the market breaks out up above 133, we could close the trade early, and we're going to be able to close it profitably. But we've gotten to a point where break even is a lot easier to get to. So because we've absorbed so much time value, if the market winds up just kind of meandering up there, we're likely to the trader who bought the debit spread could be in a much better position than the trader who just bought the call option itself. So it may be one more way in which we look at this from the perspective of, okay, well, I like the idea or the concept seems okay, but is there a way for me to reduce or take a little bit more control over those factors that I want to that I want to deal with? So those that I might want to reduce. And in this case, my objective would be to reduce the amount of exposure and time value.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.